Hello and welcome to our Principles of Accounting 2 tutoring session over Chapter 18. In your book, this chapter is over cost, volume, profit analysis. In the previous chapters, we were talking about direct materials, direct labor, and manufacturing overhead and the production of items. Now we're going to be classifying costs, okay? So this chapter starts on page 946 in your text, and I'm assuming you've already read the chapter, but if not, go take a glance at that. So big picture, cost, volume, profit analysis is, by definition from the book, is the effect that changes in cost and volume or activity level have on a company's profit, okay? So like I said, we're going to be classifying costs, okay? So the two large categories you have of classifying these costs are your variable costs and your fixed costs, okay? And then a third kind of cost that is broken up and has components of both variable and fixed are mixed cost, okay? So, like I said, starting on page 946 and 947, it talks about the definition of those. So, first let's talk about variable costs, okay? Variable costs, by definition of the book, vary in total directly and proportionally with changes in activity level, okay? So, if I was to make your textbook, for example, okay, let's say the paper, okay, the paper that's used in making the book. If I make one book, let's say it has $10 worth of paper in it, okay? If I make two books, that's going to have $20 worth of paper in it, right? 3 books, $30 worth of paper, okay? So according to making a book, okay, especially as big as this accounting book, paper for the book is a variable cost, okay? It varies in total directly and proportionately with changes in activity level. The more volume, the more books we make, the more paper we're going to be using, okay? So that's the first cost. The second one is a fixed cost, okay? So let's say I have straight line depreciation on a machine that prints, a printer that prints all the information on the paper of the book, okay? Depreciation on the machine isn't going to change if it's straight line according to activity level, okay? So if you remember back to Principles of Accounting 1, we talked about the different modes of depreciation. So you've got your straight line depreciation, your double declining balance, and your units of activity. Okay, so this is a little side note on that idea. If you have your straight line or your double declining balance depreciation, neither one of those have to do with your volume or activity level, okay? So whether I make one book or I make 1,000,000 books, okay, the depreciation as far as the printing machine, isn't going to make a difference, okay? However, if it was units of activity depreciation method, okay, that would actually correspond to changes in activity level, okay? So the example we had for that was driving a truck, okay? So the example was if you drive the truck 1 mile, you'll depreciate it X amount. And then if you drive the truck 1,000,000 miles, you'll depreciate a larger X amount, okay? So those are the two main ideas of cost, and like I said, those are on page 946 and 947, and they give an example that you can read about with computers that have to do with the camera. Mixed cost, okay, so I said there was like a third little umbrella underneath variable and fixed costs. So mixed costs have both fixed and variable components, okay? So an example of this that you might find in some of your homework problems would be like telephone, okay? So you pay X amount a month to have service from a telephone company, okay? So part of that when you get your bill is a fixed cost, okay? Whether I use the phone 1,000,000 minutes or 1 minute a month, okay? I'm going to pay that base amount, which is a fixed aspect, okay? Let's say they charge me X amount per minute that I'm on the phone, okay? That part is variable because the more minutes that I'm on the phone, the more they're going to charge me. So mixed costs have elements of variable and fixed costs, okay? So carrying on with the chapter, you'll need to know how to calculate variable unit costs, okay? So variable unit cost, okay, is what the unit cost is concerning variable cost, okay? So the formula for that, let me find you a page number for that. And that's beginning with the more cost volume profit analysis. I'm actually not seeing it in the book, but I have it written down right here. So, like I said, to find your variable unit cost, okay, that's going to be using the high-low method. So, to find your variable unit cost, you'll line up your units and your total cost, okay? And you'll take the high and the low of each one of those categories, okay? And then you'll determine the variable cost per unit. So I'm going to hold this up, and you can pause the frame if you feel needed, and look at this. And you'll want to note the variable unit cost formula, which is change in total cost divided by change in activity level. Okay, go ahead and take a look at that. Okay, so continuing on, if you got a chance to look at that a little bit, you'll notice that for the variable unit cost, you would have taken your $15,000 minus your $13,500 divided by $8,500 minus $7,500, okay, which means it's $1.50 per mile, okay, as far as this is concerned, okay. And you'll notice that very last part is total cost is equal to fixed and your variable cost added together, okay. So that's an example using the high-low method, and that's going to be used to calculate your variable unit cost. The next couple of things you'll need to be able to do is determine what type of costs are for what type of items. So I'm referring to an exercise similar to that of exercise 18.4. I'm going to go ahead and flip there and tell you the page number for that. Exercise 18.4 is on page 972, so if you've got your book, go ahead and turn to that and we'll go through this exercise. The first one says wood used in the production of furniture, okay? So if you're using wood to make furniture, okay, the more furniture you make, the more wood you're going to have to use, okay? So according to our definitions, that would be a variable cost, okay? The second one is fuel used in delivery trucks, okay? Delivery trucks. If they have nothing to deliver, they're not going to use fuel. If they have a million things to deliver, they're going to use a lot of fuel. So, according to our volume activity level, fuel is a variable cost. Good. 3 is straight line depreciation on factory building. We already talked about this one. I hope you know where this is going. So, straight line depreciation on the factory building, okay? That is not going to change whether you make one item or a million, okay? So straight line or double declining balance depreciation is a fixed cost. However, if it was the units of activity method, it would be variable. Great. Number 4 is screws used in the production of furniture, okay? The more furniture you make, the more screws you're going to need to put the stuff together, variable cost. 5, it's the sales staff salaries, okay? When you're given a salary, okay, that's not by the hour. You know, you're not paid by the hour if you have a salary. So salaries are going to be fixed, okay? And you might be thinking, wait a minute, I want you to look at number 6. Number 6 says sales commissions, okay? Commission is paid on a selling basis. So the more you sell, the higher your commission. So commissions are variable. They're not like a salary. Salaries are fixed. But hourly wages and commissions are variable. Number 7 says property taxes, okay? Whether you make one item or a million items, I'm sure you're tired of me saying that already, your property taxes are going to be the same, so that's fixed. Number 8, it says insurance on buildings, okay? You have the building no matter how much stuff is being produced and coming out the doors, so the insurance would be fixed. Number 9 is hourly wages of furniture craftsmen. If the furniture craftsmen are making more chairs, they're going to be working longer, so they're going to have a higher wage. So that's direct labor, so direct labor would be variable. Number 10 is salaries of factory supervisors. Okay, salary, we already talked about that, so salaries would be fixed. Excuse me. 11 is utilities expense. Okay, so that one, and even number 12 is telephone bill. Those are similar. Like I gave the example with the telephone. Those are both mixed, okay? So for your utilities, you're going to be charged a base amount to have a contract or have the availability of electricity, for example. But depending on how much you use, your bill's going to vary. So if you think about it, if you were paying the bills for the company, okay, and you got a really high bill for direct materials, that means you made more items, okay? If you got the notice of how much depreciation was allocated for the month, that doesn't really show you how much you produced, okay? And mixed costs, in the summer you have more air conditioning, so your electricity bill will be higher. So just examples like that. So that is concerning the analyzing and categorizing of costs, okay? So the last little thing that I want to talk about is break even. You'll need to know how to calculate break even dollars and break even units in this chapter. So breaking even, I'm sure you've heard that term before, it means no profit, okay? So break even units, what that would be saying is how many accounting textbooks do I have to sell to break even, okay? Respectively, break even dollars is how much do I need to make in order to break even, to have no product, or to have no profit, excuse me. So that's the basics of cost, volume, profit analysis. And one last thing I don't want to forget, contribution margin. Make sure you know what that is. I believe, I'm looking at it in the glossary. So contribution margin is, by definition, the amount of revenue remaining after deducting variable costs, okay? So there's a formula I want you to look at on page... Well, I have it written out here. So you have cost, volume, profit analysis, which is equal to sales, subtract variable costs, equals your contribution margin, okay? Subtract fixed cost equals net income, okay? I wish I could give you a page number because my notes are kind of sloppy. Doesn't look like they have the full one, so just bear with my handwriting on this one. It's this little thing I have written right here, okay? So cost, volume, profit analysis is equal to sales minus variable cost equals contribution margin. Subtract fixed cost is equal to net income. Okay? So that's an introduction to cost, volume, profit analysis. That's chapter 18. And if, like I said, if you haven't read the chapter, go ahead and do that because I'm pretty sure not a lot of this would have made sense if you haven't. So I hope that was helpful. And as always, if you have questions, please post them to the question and answer board on Moodle. Thank you, and we'll see you next time.